when we discuss about the challenges faced by a new entity in terms of the VAT implementation, the first and foremost thing is about the registration. The tax law has specifically mentioned the threshold tax value limit of 375,000 AED for the mandatory registration. And also the law specifically says that if you wanted to choose as a voluntary tax registrant, the threshold turnover amount is 187,500, which means any entity who is expecting a turnover value of approximately 375,000 or 187,500 should register the entity with the tax authorities. The taxable supply, meaning the taxable output and the value of the imports. And the taxable supply does not mean that this is going to be inclusive of the local taxable expenses. This is very, very important. Taxable value is the sum of total output tax and the value of the imports. However, taxable supply does not include the local purchases. Say for example, an entity buy and incur local expenses with VAT at 5%. This is not going to count under the taxable supply. The challenge the entity is going to face, say for example, the tax registration application has to be processed with the tax authorities. The problem by the new entity would be the entity has to specifically confirm that the entity is going to achieve the threshold turnover within 30 days after the registration. So practically what is happening, when we apply for the registration, we expect certain value of the turnover, which may not be realistic later on. So the scenario work out like we are not able to claim the input taxes if the entity is not registered. But at the same time, if you wanted to register, the turnover threshold limit has to be crossed. So this situation has some kind of panic and confusing the clients in UAE overall. But however, on a special cases or a special request to FTA, they mostly listen the cases and waive off the threshold limit prescriptions, and on case to case they give the registration numbers to the entity. But an entity has to diagnose and understand particular scenario on the revenue and registration parameters. Identifying and choosing a proper software to support the VAT compliance is very, very vital and important for every new entities. Remember, a good software can save a lot of time in terms of the data analysis, report generations, etc. So before we choose a software, the entity has to conduct proper due diligence whether the proper software is able to generate all the proper tax codes, or is it accredited with the tax authorities and is able to generate the required management information system for tax compliances. So the new entity should conduct every due diligence before they choose the software support. The entity may choose a proper tax agent or a tax consultant who possesses the specific qualification and relevant industry experience, who can help us in a bigger way in terms of the VAT compliances. By hiring a tax consultant or a tax agent, he can support us in doing the gap analysis, data entry, even the data analysis, etc., which the industry can save a lot of time in doing the day-to-day VAT compliances. And of course, the record maintenance is also another issue which the industry, the new entity is facing. So the tax consultant or a tax agent can support the industry in getting the relevant and latest information from the tax authorities on time whenever the entity needs the information. Mandatory VAT record maintenance is another challenge which every new entity will be facing. For example, the VAT records for supporting transactions like output tax, input tax claims, and all the VAT compliances has to be maintained by every entity on a day-to-day basis. By not maintaining the proper VAT records, we are just ending up with a situation that either the input tax claims may get rejected by the authority, or it will end up with the heavy penalty situations from the authorities. So record maintenance as per the regulations prescribed by the law is very, very important for every new entity. Extra precautions to be taken to maintain the support and valid document for all the banking transactions are now very, very important. All the transactions effected in the bank account either deposits or withdrawal should be supported with the proper VAT records. And this mandatory document maintenance for the banking transactions is very, very important at the post VAT era, which was not very common in United Arab Emirates earlier. Now, say for example, mostly the banking transactions are relevant when we do intercompany transactions, either intercompany sales or intercompany purchase or intercompany fund transfers. Now, in the post-VAT era, we have to maintain proper supporting documents to prove that any of the transactions effected in the bank has no VAT liability, or we have properly captured the VAT accounts. Tax grouping is another facility which the tax authority in UAE has been providing to the customers or the clients in UAE. By grouping under the tax group, we can put all the entity in one group under the one tax number, which will save a lot of time and energy in terms of the VAT compliance. Say for example, when we file the VAT returns, it has to be grouped in one number, and only we need to submit one tax report for all the group entities putting together. But only precaution, or rather the caution we need to take while grouping is that we have to do a proper due diligence on all the entity before we group it, because otherwise if we make a mistake on grouping, it will end up either with a penalty situation or non-compliance. Evaluating the contracts is also relevant in terms of long-term contracts for the operations, capital assets, etc. The entity should be able to identify the tax inclusions or tax exclusion from all the contracts in place these days, because the VAT complexity starts with relevant paragraphs within the contract. So every entity should be able to identify the relevant clauses from the contracts to ensure that we have properly defined the contractual obligations in terms of the VAT. Another challenge a new entity would face is on the deregistration. The tax law is very clear on the conditions and terms when an entity should apply for a deregistration. For example, when the entity ceases to operate, or when the transactions of the taxable supply falls below the threshold turnover limit. The entity has to apply for the deregistration within the specified time prescribed by the law. Failing to apply on a tax deregistration is going to attract heavy administrative penalties. Tax authorities have already announced the scenarios where the entities would end up with administrative penalty from the tax authorities. Say for example, failure to collect tax, or it could be even failure to remit the tax on time, or it could be failure in terms of submitting the VAT return on time. These are the scenarios where the client would end up with heavy penalty from the tax department. So the new entity should be properly diagnosed, and they should be thoroughly aware of the situations and scenario where the violations and the penalty clauses would be applicable.